Hello, everyone, and welcome to PenFinancial Credit Union's Good Credit, Bad Credit webinar. My name is Josh Schulke, and I will be the moderator here tonight. We have a great topic for you. Good credit, bad credit is the topic, and as we approach the holiday season, an even more important topic. I'm joined here tonight by our PenFinancial experts, Main Street Branch Manager Ian Scott, and Financial Services Specialist at our Dorchester branch, Catherine Palmer. If at any point you are having technical difficulties, I encourage you just to let us know via the chat function on the right side of the screen. Also, if you have any questions, feel free to type them in the chat area as well. And Ian and Catherine will be happy to answer them at the end of the presentation here tonight. So without further ado, I'm going to turn it over to Ian and Catherine to take you through the webinar, and I'll take over again at the end for the Q&A portion.
Great. Thanks, Josh. On tonight's presentation, we're going to cover the reasons for borrowing, types of borrowing, how to improve your credit score, how to obtain your credit bureau, how to read your credit bureau, debt-to-income ratio, benefits of debt reduction, and keeping your credit in check. So let's look at some reasons to borrow. Purchasing your home, purchasing your automobile, paying for education, for your retirement, to invest, for your own business, to reduce interest rate on debt you already have. Now let's look at some reasons not to borrow. To pay bills like utilities, cell phones, etc. Occasional expenses like your child's sports, car repairs, etc. Consumption items like groceries, restaurants, clothes. When you can't afford the payment, don't borrow. Let's look at some types of borrowing. There's mortgages. That's a really good borrowing because you're purchasing an asset. Line of credits are okay as long as they're used properly and for the right purposes. Loans, installment loans are good as well as long as it's a good purpose as well. Credit card, bad if you can't pay it in full. Payday loans, not good at all. Overdraft, bad if you can't cover it every pay.
Thanks, Ian. Now I'm going to talk about your credit score. Your Equifax TransUnion Beacon scores tell our lenders how much of a risk a borrower may be. Beacon scores range from 300 to 900. The average Canadian adult has a Beacon score of over 700. As of October 2013, the minimum credit score for high-ratio insured mortgages is 600. Let's talk about how to improve your credit score. There are ways to improve it. One is your payment history. Make your payments on time. Utilization, that's the percentage of the available credit you use. The length of credit history, how long you have been with that particular lender. The number of inquiries into your credit bureau, example, the hits against your credit bureau, and the types of credits. Payment history. This is the most important factor for your credit score and eligibility as a borrower. How well you pay your credit facility, required payments. Your score is reduced if your payments are made more than 30, 60, or 90 days beyond due dates. Have accounts that are sent to a collection agency. If you declare bankruptcy and consumer proposal within 6 to 8 years, or withhold payments due to a dispute and the lender reports your late payments. Payment history represents 35% of your credit score. Utilization, maximum 35% of available credit. If you are over 35%, it lowers your credit score. Add up your available credit. Credit cards, not uncommon to see $20,000 limits, line of credit, and home equity line of credits. You may be seen as a credit risk to your lender if you have a large amount of unused credit. When you use a larger percentage of your available credit, lenders also see you as a credit risk. Utilization represents 30% of your credit score. The length of credit history. The longer you have an account open and have used it, the better it is for your credit score. Your credit score may be reduced if you have credit accounts that are relatively new, or you close older accounts and keep your remaining newer accounts open. The length of credit history represents 15% of your credit score. Credit inquiries. When lenders and others ask a credit reporting agency for your credit report, it is recorded as an inquiry. If there are too many inquiries on your credit report, lenders become concerned. Inquiries that are hard hit could be credit card applications. Soft hits are inquiries that do not affect your credit score, like requesting your own credit report. Credit inquiries represent 10% of your credit score. Types of credit. Your score may be lower if you have only one type of credit product. Installment credit versus revolving credit. It's better to have a mix of different types of credit, like a credit card, an automobile loan, or a line of credit, your mortgage. Types of credit represent 10% of your credit score. And this is the breakdown of the credit score characteristics. Payment history represents 35%. Utilization represents 30%. History represents 15%. Credit inquiries represent 10%. And type of credits represent 10%. There are advantages to having lines of credit. Interest rates usually lower. No setup fees, annual fees, or penalty charges for paying them off, and there's flexibility to borrow when needed in case of an emergency. But there's also disadvantages. You have easy access to money from a line of credit. Some people can get into serious financial trouble because they don't control their spending. Interest rates on a line of credit could go up because it's actually tied to the prime lending rate. You are required to pay the interest every month, but you may not have to make regular payments on the amount you have borrowed. For instance, a purchase can be obsolete before it is paid off. Tips to improve your credit score. Make your payments on time. If you can't pay the full amount, make at least the minimum payment or more. If you think you're having trouble paying a bill, contact your lender right away. Communication with the lender is essential. Try to use 35% or less of your available credit. Consider keeping older accounts open even if you no longer need them, and use them from time to time. However, this may affect your ratios when purchasing a new home with the new CMHC rules coming into effect in 2014. Limit the number of times you apply for credit in a short period of time. Have a mix of credit products. Could get you more points, but don't go overboard. Make sure you can afford to pay back the money you borrow. Use credit responsibly.
Okay, let's have a look at how to obtain your own credit bureau. First thing you want to do is go into Equifax's website at www.equifax.ca. Go under the Personal tab and look down under Other Credit Services. You can see how you can receive a free credit file. So you click on that, and it's going to take you to this next screen. This next screen, it's going to show you two ways you can get your own credit bureau. One is to call for a free credit report on the phone, the 1-800 number. Remember, when calling this number, they are going to ask you for some personal information so they know you are who you say you are. The second way is to order your free credit report by mail or fax. You fill in the Canadian Credit Report Request form. Once that's filled in, you can either fax it to the number at the bottom or you can mail it to the address just above it. So once you have your own credit bureau in front of you, it's just as important for you to know how to read it. So let's have a look at how to read a credit bureau. The first thing at the top of the line will be the consumer referral. All Equifax referrals are referred to the 1-800 number. The next line would be a consumer file alert. This could be an alert that says, caution, wrong social insurance number, or caution, wrong birth date. What this means is that your social insurance number or the birth date used to access this file is not the one that's attached to the file. The next section is the file reference numbers. This is just the reference numbers used by Equifax for the file. The next part is the identification section. This is where your address will be, and you can look at your address over the next almost 10 years. So you can look at this and make sure that it's in the sequence that you moved from. Another part under identification could be AKA. That stands for also known as. And what could be in there, for example, is if a young lady's been married and she changes her last name, it still may have a file under her maiden name. The other information on this section could be telephone numbers, first date reported, and things like that. The next one is the inquiry section. The inquiry section is going to list the hard credit inquiries that you've had against your credit bureau. Anyone who's sent in an access that is reviewing your credit. So you can look at this and see, if you know you applied for a MasterCard at Bank of Montreal, there should be an inquiry by Bank of Montreal on your inquiry section. The next part is the employment section. Very similar to the housing section, it should show your jobs over the last, say, 10 years. And you can look to make sure the sequence is correct. The next section after that is the public records or other information. What can be on the public records is if you've been bankrupt, it will show the bankruptcy. It'll indicate the time frames, the liability, the assets, and when you were discharged, if you've been discharged. Another thing that could be there is collections, and it'll show whether they're paid or unpaid, the amounts they were, and the dates. Another part could be a judgment. If you've had a judgment against you, again, it'll show the dates and the amount. Another thing that you often see there is security. What that means is when you go out and purchase your car, the bank that lends you the money registers against your car, and that security registration will appear in this section. Let's look at portfolio types and ratings. So on your left-hand side, you'll notice R for revolving, O for open, I for installment, L for lease, C for line of credit, and M for mortgage. And then to your right is the payment rating on that type of account. So let's have a look. If it's a 0, it's too new to rate, which means you haven't used the card yet and haven't made a payment. If it's a 1, that's the desired rating. It means you pay all of your bills within 30 days and not late. 2 means that you've paid your bills longer than 30 days but under 60. 3 is over 60 days but under 90. 4 is over 90 but under 120. And 5 is over 120. 7 is if you were in a consumer proposal. 8 is if you've had a repossession of a vehicle. And 9 is your debt has been written off. So obviously, the higher the rating, the worse it is. The preferred rating is a 1. So what does this mean to you? If you have a MasterCard, that's considered a revolving. And if you always pay it within the 30 days, it would be rated R1. That's the ratings you want to see. R1, I1, all the way down the board. Back under the trade information for your section on your file, the trade information, there will be a trade line for every trade that you currently have open on your credit bureau. It will include things like the bank that gave you the trade line, the high credit on it, the terms on it, the balance on it. If there's anything past due, there's the rating. If you look at the first one, this loan has been rated I2, so this person is late. And it indicates a payment record. Notice all of the ones which indicate this loan had been paid perfectly until the last rating period. And there will be one of these sections for every loan, credit card, line of credit that you have on your credit bureau. The another part is the narrative section. The narrative section includes warnings typically. And these can be if someone has tried to use your identification to obtain credit, there'll be a warning on there for the individual. These are for the individual who pull your credit file. They're reviewing your credit file. It's giving them a warning, something they have to check. So in this situation, they'd want to check that you are the legitimate person applying for this credit. Another type of warning you often see is if an individual has lost all of their identification. The next part is, how long do these things stay on your credit bureau? What are the retention and purge rules? For inquiries, it's 3 years. Unless you have less than 5 inquiries, they stay on forever. For judgments, collections, trade items, previous high rates, things like bankruptcy, secured loans, banking items, they're on for 6 years, depending on whether it's from the last activity or payment date. And then bankruptcy category, meaning a settled one, could be 3 years. The last part that we're going to look at is the scores and reason codes. So if you look at this score, for example, it's a score of 541. We know from what we've heard already, this is a low score. And if you notice the recap that goes underneath, the recap just recaps some of the things that have led to this score. So this person has either had serious delinquency, maybe a public record, which could be a judgment or collection. They've had delinquency recently on their credit bureau. Maybe their time that they've had credit's been very short. Maybe they have subprime credit, so they've got creditors on there that are from the subprime. So that gives you an idea of how to read your credit bureau and should help you in future when keeping a track and reviewing your credit.
You may have heard your lender talk about debt servicing. What is your debt-to-income ratio? The average Canadian's debt-to-personal disposable income ratio is at a record 165%. For every dollar of disposable income they make, Canadians almost owe 2/3 more than that in consumer debt. Two ways to calculate your debt-to-income ratio. One is the traditional method used by most financial institutions. You take your monthly debt obligations, your mortgage payments, rent, credit card payments, and divide that by your gross income before deductions. Also, debt-to-income ratio, take all your debts, including your mortgage, and divide after tax income. What is a good debt-to-income ratio? 36% or less. This is ideal. The ideal amount of debt for most people to carry. 37 to 42%. At this level, start reducing spending now before you dig yourself further into debt. 43 to 49%, you could be in financial distress, and you have to act quickly to prevent it. 50% or more, you need professional assistance to severely reduce your debt load. There are benefits of debt reduction. Lowering your debt-to-income ratio. Your income is substantially more than the amount of debt you owe. If you have a high debt-to-income ratio, over 40%, it will be difficult for you to secure a loan. By reducing your debt, you can reduce your debt-to-income ratio. It gives you less stress. When people are dealing with mountains of debt, they're much more likely to report health problems and marital problems. Reducing or eliminating debt can lower stress and improve your mental health. There are even more benefits to debt reduction. It gives you freedom to save. Less debt, freedom to save money for larger purchases such as a home or a car. Instead of paying interest and fees, you can put money toward retirement savings or another financial goal. It gives you freedom to spend. When you don't have that debt load, you are free to do what you want with your hard-earned money. When you have little or no debt, you don't have to worry about every little bit of your money going towards your debt and interest payments. Some ways to reduce debt. Pay at least the minimum on each debt. Ask for a lower interest rate. Stop using your credit cards. Consider a consolidation loan. Trimming your budget, or talk to a professional. Come to one of our PenFinancial branches for your personal financial checkup. Consolidate your debt and build your net worth. Help reduce the stress. Keep your credit in check. Becoming familiar with your credit report is an important part of financial fitness at all stages. The better your credit rating, the better interest rate you're likely to receive. 730 and above is an excellent credit score. 700 to 729 is very good and above average. 670 to 699 is a good credit score. 585 to 669 is cautionary, it's fair credit, and 584 or below is poor credit. Grow your credit score.
Okay, so that concludes the formal portion of the presentation. As expected, a few questions have come in, so we'll get to them shortly. If anyone else has any questions, feel free just to type them in the chat area on the right side of the screen. The first question is from Alice, and she asks, where does credit begin?
Well, I can answer that one, Alice. Basically, when you make that first application for credit, your file will be started. So you've got your first job and decided to get a credit card. You go into your credit union and apply for a credit card. When they pull that credit to see if you have credit, that will initiate your file. There won't be a score on it yet. You don't get a score until you've gotten some approved credit and you show some history with that. Upon that, it will collect all the information and give you a score.
Great. Another question comes in from Randy, and he says, is it only financial institutions that report to the credit bureau?
Thanks for your question, Randy. No, the cell phone companies report to the credit bureau. You have to be very careful. If you miss one payment, it is reported. Also, landlords can report to the credit bureau and collection agencies. Be very careful and keep an eye on your own credit report.
Okay, and the last question that came in, unless anyone else has any others, is it only financial institutions that use credit score?
No, that's not true either. Other than financial institutions, your job could look for your credit score. Any bonded employee, they're going to check their credit to make sure that it's good, so that they'll bond them. Other things that look for credit scores, we go to rent an apartment. Often now the application will include a waiver where they're going to pull your credit score. Really anything that could provide a service for money may ask to check your credit to make sure that you have good credit to get that service.
Okay, that's great. So thank you very much for your information, guys. I don't see any more questions, so I think that kind of concludes our webinar. I know there's a lot of information to take in, so if you missed any portion of it, or maybe we went over something too fast, we do record and archive all of our webinars, so you can actually go to the Webinar Center on our website. If you go to our homepage here on the screen, you can see the Webinar Center icon is on the right-hand side. So if you click in there, you'll see all the archived webinars that we've done. And we'll also list a schedule of upcoming webinars as well. So we have a number of great topics moving into 2014. So you want to stay posted. And also, if you have an idea for a good topic that you'd like to see covered, feel free to connect with us at email us at PenFinancial.com, or you can go on our Facebook or Twitter account and let us know in there as well. And hopefully we can cover the topic for you. So thank you very much again to Ian and Catherine for coming in and presenting today. Thank you for all of you guys for tuning in. And I hope you guys have a great night. Thanks.